welcome to the debate. The crypto market here in 2026 presents, well, a fundamental intellectual challenge. On one hand, we are witnessing an economic paradigm shift. We have unprecedented institutional capital just pouring in, and it seems to be validating the entire premise of digital assets. We're hearing forecasts of a, quote, crypto supercycle, all driven by some much-needed U.S. regulatory clarity, things like the Genius Act on stablecoins and the anticipated Clarity Act. But, on the other hand, the year is beginning with some really high-profile security crisis, Tether freezing hundreds of millions, and these deeply concerning reports of physical threats, over 20 crypto-targeted kidnappings in France since early 2025. So the central question for us today is this. Does this push for institutional integration and regulation actually ensure structural stability in mass adoption? Or does it just empower central gatekeepers and mask these persistent, maybe even fatal security vulnerabilities? I'm going to argue that regulatory alignment is the only real path to stability and enduring growth.
And I'm going to argue that this institutionalization introduces unacceptable risks, specifically centralization risks, that fundamentally undermine the entire original ethos of crypto. By seeking the comfort of that integration, we are sacrificing the core principles of user sovereignty and, well, permissionless operation.
I see the institutional influx not as a threat, but as the inevitable and necessary maturation of the market. We're finally moving past the speculative, retail-driven momentum that really defined all the past cycles. The evidence is overwhelming, especially here in the U.S. Landmark regulatory advances, specifically the Genius Act, which clarified the status of regulated stablecoins. That has enabled spot crypto ETPs to pull in, staggering net inflows of over $56 billion globally since just January of 2024.
Right.
And this isn't just fleeting retail excitement. This is a structural change. Grayscale notes that this steadier institutional buying is fundamentally shifting market dynamics. They're predicting it will mark the, quote, end of the so-called 4-year cycle. Big corporate players like Coinbase are now anticipating transformative growth for 2026, and it's precisely because they have that regulatory clarity. This maturation, it requires specialized regulated infrastructure. It's why we're seeing the rise of digital asset treasuries, DAT 2.0, and the development of next-gen systems like Onyxcoin's Goliath network. These are compliance systems built for real-world financial demands.
The problem with that vision is that you're celebrating the creation of a velvet cage. This institutional era you're describing, it fundamentally creates a dangerous power asymmetry. It forces this sharper distinction between assets that can comply with centralized regulation and those that, maintain the truly open, permissionless nature of decentralized finance. And we have to acknowledge the philosophical side of this. Vitalik Buterin himself critiques this whole environment. He calls it corposlop, this layer of centralized proprietary apps being built on top of decentralized protocols. He argues that modern sovereignty has to include securing one's psychological autonomy from these algorithms and from corporate data extraction. And look, this isn't just philosophy. The risks are immediate and they're lethal. Tether's recent $180 million freeze shows the power held by these central admins, the admin keys. And worse, the physical attacks in France, where we've seen these tragic incidents, investors and their families being assaulted, allegedly linked to crypto taxpayer data being shared by government employees. That shows the mortal danger of mandatory reporting and non-sovereign holdings. Compliance, in this context, isn't safety. It is mandatory vulnerability.
Okay, let's address that tension directly, because the institutional side sees compliance as the necessary safeguard, not the vulnerability. When we look at the adoption curve, regulated stable value is clearly the #1 use case. Our models are forecasting stablecoins will reach, $1.2 trillion by the end of 2028? That proves the market desperately needs what these regulated assets offer. I see why you think the Tether's control is damning, but let me give you a different perspective on centralization. Utility. Large institutions like BNY Mellon, they're working with firms like Ripple and Circle, and they've successfully launched tokenized deposit services for their clients. This hybrid approach, it's about enabling 24/7 settlement and programmable payments for really complex transactions, margin management, large-scale cross-border settlement. The Genius Act legitimized these assets as a cornerstone of the U.S. financial system. It shows we can get the speed of crypto without sacrificing the safety that the world's biggest financial players demand. The ability to freeze assets, while yes concerning in some contexts, is the mechanism that ensures the integrity of the system against illicit finance. And that is a massive benefit to global stability.
I'm sorry, but I just don't buy that. I don't buy that the sacrifice of censorship resistance is justified by the promise of 24/7 settlement. Let me tell you why. That speed comes at the cost of genuine financial sovereignty. Tether's ability to instantly freeze over $180 million with its smart contract admin keys, that isn't just compliance, it is the instantaneous removal of property rights, all based on undisclosed triggers. And the data confirms this, right? Forensic data shows Tether froze roughly $3.3 billion between 2023 and 2025 across thousands of addresses. So this confirms that in your regulated model, compliance supersedes sovereignty. If you hold these assets, you are a tenant, you are not an owner. The critical unmet demand in this market is not for more stability, it is for confidentiality. As public blockchains become the standard, the need to protect sensitive financial data just goes up exponentially. That's why we saw Zcash, ZEC, see focused investor accumulation even during market volatility. People are actively seeking cryptographic tools that offer protection precisely because they reject the mandatory centralized transparency of your regulated stablecoin model.
Well, to pivot slightly, this whole movement toward institutional integration changes more than just utility. It fundamentally alters market predictability. You argue that the foundations are weak, but Grayscale is right. The 4-year cycle is ending, the macro backdrop is supportive, the Fed cut rates 3 times in 2025, they're expected to continue this year, which just encourages capital to move into risk assets.
Okay.
That's an interesting point on privacy, though. I would frame the current market activity very differently. The new depth of liquidity is staggering. It absorbed a $181 million supply shock, a massive move of 2,000 BTC by a Satoshi-era miner to Coinbase, and the market didn't even flinch. That absorption is the true proof that institutional capital is deep enough to prevent the catastrophic drawdowns we saw in the past. And look, price weakness is temporary. Bitcoin is currently trading below the estimated miner production cost of about $101,000 per BTC, a level that has historically acted as a floor. Technical analysis, like the cup and handle pattern forming, suggests BTC is preparing for a significant breakout. Stability isn't just about prices. It's about structural resilience.
That's a compelling argument about liquidity, but have you considered that market resilience might just mean institutions can handle large sales, not that long-term conviction is actually deepened? Bullish price momentum is fragile because it's driven by short-term speculation, often totally disconnected from any underlying belief system. I mean, look closely at the data you're citing. XRP's price breakout, it stalled immediately when inflows into the XRP spot ETF dropped by a staggering 84%. That is not conviction. That is momentum chasing capital with a very, very short exit window. And furthermore, if we look at long-term holders in assets like Cardano, ADA, the data shows the patient capital, the 1 to 2 year cohort, is actively distributing their supply. They're selling into the institutional hype while short-term speculative capital is stepping in. That makes the price stability around the 38-cent support zone extremely fragile. Even Ethereum, despite all the institutional staking, is forming a bearish head and shoulders pattern that implies a potential 9% downside risk. So the liquidity you celebrate, it's just facilitating the exit of high conviction holders. The market is liquid, yes, but its stability is built on very fragile, fleeting capital.
I think you're overlooking the efficiency gains that this kind of well-regulated integration brings to the average user. Platforms like X, formerly Twitter, are recognizing their role as vital financial infrastructure. We are moving toward a necessary convergence of conversation and commerce. The upcoming launch of smart cash tags, scheduled for February, is a perfect example. It's going to integrate real-time price data and potential trading execution right into the social conversation, likely through partners like Coinbase. This is critical for mass adoption. You collapse the entire trading funnel from discovery to execution into a single tap. This level of immediate utility is what finally gets crypto beyond the technocratic elite.
I'm just not convinced by that line of reasoning, because you are substituting a decentralized public utility for a private centralized gatekeeper. Relying on private platforms for financial discovery concentrates massive, unauditable power into the hands of a few corporations. We are literally replacing the open protocol layer with proprietary, closed social platforms. Buterin's critiques of X are incredibly relevant here. He's calling for cryptographic proofs of feed execution, arguing users must be able to audit their own reach and understand why content might be suppressed by a centralized algorithm. Without that, the power asymmetry just gets worse. And what's more, this whole idea of organic integration is being challenged by traditional finance itself. We know this opaque advocacy group, Investors for Transparency, is running ad campaigns opposing DeFi's inclusion in the Clarity Act. This proves that established finance views decentralized infrastructure not as something to embrace, but as a direct threat they're actively trying to kill to maintain control. This isn't organic evolution. It's a forced centralization driven by regulatory capture.
Our perspective remains that compliance and integration are, well, the unavoidable and most effective path to a durable ecosystem. The legal frameworks like Genius and the institutional vehicles like ETPs, they are necessary to channel serious, reliable capital. This structure is ending the arbitrary boom-bust cycles and creating the resilience required for true mass participation. We're moving towards a productive future, exemplified by compliant financial-grade infrastructure like Onyxcoin's modular Goliath network, designed specifically for this new reality.
But the acceptance you champion comes at a cost that the original crypto movement just refused to pay: user sovereignty, privacy, and true decentralization. While the growth is apparent, the underlying structural risk, both physical, as we've tragically seen in France, and digital, as shown by the unilateral power of stablecoin issuers, it remains dangerously high. The real challenge is ensuring the open financial system remains genuinely open and permissionless, not merely filtered through and approved by centralized corporate structures.
So the debate really centers on whether 2026 is truly the dawn of the institutional era, where stability leads to predictable, durable growth, or whether the current structures are simply accelerating the move toward a corpus-locked digital future, leaving that fundamental quest for user sovereignty not only unresolved, but perhaps more threatened than ever before.